we meet once again in the middle of yet another lockdown. And something interesting also happened last week. Right? Did you notice what the central bank did on Thursday?
The standing lending facility rate and standing deposit facility rate changed out.
Yeah,
Policy rates
those rates,
changed.
policy rates were increased by 0.5%. And also, what did they do to the reserve?
Increased.
Yeah,
Increased by 2%.
very good. 2% was increased to 4%. Correct? Right now, what's significant to us is we're in the middle of evaluating projects, right? We discussed last week about payback, discounted payback, net present value. Remember? So when interest rates increase, our discount rate will also increase, right? So that is the impact to the economy, right? So you all know that, like we discussed, when interest rates increase, the discounting factor will reduce, isn't it? 1 over 1 plus R will reduce now. So when that happens, whatever the cash flows we receive in the future will have a lower value today, right? The present value of future cash flows will be lower, right? So that's the impact of an interest rate increase. Okay, so we stopped at modified internal rate of return, isn't it? We discussed multiple discount rates when you're using IRR, right? So if IRR, under the IRR concept, if you have non-normal cash flows, you will end up with multiple IRRs, which is a drawback of IRR. Now to address that issue of ending up with multiple IRR, we have what we call modified internal rate of return, MIRR, right? So let's go through this. Modified IRR is used to address the weakness of multiple IRRs, right? That means if you have non-normal cash flows, remember this is the most important concept, right? More than the calculation, you should know the basics. So if you end up with non-normal cash flows, you notice non-normal cash flows and you're asked to recommend a method of appraising the investment, project appraiser, you should go for modified internal rate of return, because if you say you can use if you say you can use IRR, it is wrong, because if you use IRR for non-normal cash flows, you will end up with multiple IRR. That's right. So to address that, you have modified internal rate of return. It's the discount rate at which present value of terminal value is equal to investment value. Right? The present value of terminal values. Now, terminal value means if you take cash flows of projects, rather than discounting the cash flow, if you compound it to the end of the cash flow and then get the present value, it should be equal to the investment value, right? It's the discount rate at which present value of terminal values is equal to investment value. Terminal value is calculated by discounting terminal value at weighted average cost of capital. Okay, so TV stands for terminal value, is calculated by discounting terminal value at weighted average cost of capital. It is assumed that reinvestments occur at weighted average cost of capital. If projects independent, now again this is a return. So if modified IRR is greater than the cost of weighted average cost of capital, then you should accept, right? Because the return is more than the cost of capital. That's the easiest way of remembering. Return is more than the cost of capital, or return is more than the cost. You accept the project. For mutually exclusive projects, accept the one with the highest IRR, and that's for as long as your modified IRR is more than cost of capital. So let's try this. This has an initial cash outflow of 100, followed by an inflow of 10. Now, this is the same project that we discussed last week. Second year has cash flow of 60, third year cash flow of 80. Right? So let's calculate MIRR. Now, to calculate MIRR, you have to take each cash flow and calculate their future values. Right? And then discount the terminal value, and it should be equal to your investment amount. Okay, so let's get cracking on this. Once again, I'll have to use Excel to illustrate any calculations. Can you all see the Excel sheet? Oh, no, I haven't shared. Hold on. You can see the sheet. So the first step is to calculate terminal value. So let's get the future value of each of these cash flows. That means the project ends in the third year, right? So from the first year, the terminal value is total of future values. 58.1. Now let's calculate the present value, terminal value. The modified IRR would be Our modified IRR says is present value of terminal value should be equal to investment. Write it the other way around. Okay, guys. So I hope that was clear. Shall you try project B also?
So, but this is a normal cash flow, no? Not an abnormal one, no?
No, this is normal cash. Yeah. If you had non-normal cash flows, then say this was minus. right? Then you don't get the future value. You have to get the present value of outflows. Right. So your investment will then be 149.5868 equal to 92.1. Okay. So that's how it will work. Okay.
Okay, sir.
Let's try the same thing for B also. So this is B, 70, 50, and 20. Right. So the first step is to calculate terminal values. So for every inflow, you calculate the future value, and if there are outflows, you calculate present value, right? Then your investment will be equal to the present value of terminal values. 1689. If these two projects are independent, which one will you pick? If A and B are independent?
Both.
Yeah, very good. You pick both. Reason?
The rate is higher than the back.
Very good. Because the modified IRR is higher than your WACC. Then if they're mutually exclusive,
Project B.
yeah, B, because it has the higher MIRR. Right. So any questions on that? Yeah, I can share the workings. Benefits of MIRR. It assumes that cash flows are reinvested at the weighted average cost of capital, right? Similar to IRR, it eliminates the issue of multiple IRR. That's the biggest benefit. Right? You won't get a problem with multiple IRRs. And in most projects, you will have non-normal cash flows rather than normal cash flows, right? So this is better suited to evaluate projects than IRR. Normal, non-normal cash flows we discussed last week. Shall we calculate MIR for this? Yes, another exercise. Let's calculate MIRR for this project. It says Pavilion project. Huh? So I'll use the same name. Cash flows are initially 500, 800, 500, 5,000 and minus 5,000. Discount rate is 10%. present value of investments. So the present value of terminal value should be your investment value. The discount rate at which the present value of terminal value is equal to the investment. %5.6%. Right, so did all of you get that? Okay, so this is a non-normal cash flows because you have an outflow, then an inflow, and again an outflow. Right? It's not normal, not a normal cash flow. Therefore, you will end up with multiple IRR. Now, this project, will you accept or reject?
So can you explain it again? What is the investment value here?
Investment value is originally 800.
800.
Then the second year you invest another 5,000. There is another outflow. No? It's not a normal cash flow. Then you have to get the future value of all inflows and the present value of investments. Right. Then the modified IRR is the discount rate at which the future value is equal. Sorry, I can hear myself being repeated. Can you mute yourself? Okay. Modified IRR is the discount rate at which the present value of all outflows is equal to terminal value of the present value of terminal values. Right. So all the present value of investments should be equal to the present value of terminal value. Clear?
Okay.
All right. So any questions? Shall we move on? Okay. This project, will you accept or reject? Your cost of capital is 10%. Modified IRR at 5.6.
Reject. No?
You will have to reject, right? Because your cost is more than the return. Then if it's you reject if it's mutually exclusive or independent.
What we reject? No?
Yeah, either way you reject, right? Because the return is less than the cost. Okay, so the next area. Shall we calculate present values of each of these projects? There are two projects, a small project and a large project. The small project runs for 2 years, the large project runs for 4 years. So let's calculate present values of each of these projects, right, at a discount rate of 10%. You put the cash flows, then you calculate discounting factors at 10% and calculate the present value of each of the cash flows, which is the cash flow into. Okay, did you calculate present value of S? The small one, then let's do the present value of a larger project. Has 4 cash flows of 33.5 every year. So if you look closely, you might see that these are annuities. Right. So you're comparing 2 projects. The first one is a 2-year project. The second one is a 4-year project. Out of these, which one would you prefer and why? Yeah. Which project would you prefer? Hello.
Project L.
A. Why? A meaning S,
Higher
right?
net present value. L.
L.
Yeah. It gives a higher net
L.
present value.
Yeah. What you should look at is now the first one is a 2-year project, second one is a 4-year project, right? So the first thing you should see is whether these have a reinvestment option, whether you can reinvest in the project or in some other project. If there is no reinvestment option, yes, you go for L, because obviously it gives the higher return, the higher net present value. Right? But if you can right, so if you can reinvest maybe in the same project, then it's difficult to compare, because S is a 2-year project, L is a 4-year project, and you can reinvest. 2 years you can reinvest in S, and after 4 years you can reinvest in L. Right, so you're comparing 2 projects which have unequal life, right? The first one is a 2-year, second one is 4 years. Now, if you can't reinvest, then very straightforward, you go for the highest NPV. But if you can reinvest, then you can't compare the 2 projects because they are spread across different time periods, right? So if no reinvestment, then you have to select L. Reinvesting. Then only the issue comes. Right. So this is what you are doing now. See, S is a 2-year project now, and you assume there is reinvestment. That means after the project ends in the second year, you can reinvest for another 2 years, right? If you reinvest for another 2 years from that point, S becomes a 4-year project in total. L is also a 4-year project, right? So let's see how you can reinvest. Let's go back to our working. Let's extract S once again. If you are reinvesting in S, it ends in the second year, and second year when it ends, you reinvest in the same project, right? So your investment, the capital is 100. First year you get 60, second year you get 60. This is how your new cash flows will look like, because the original S project you invest 100, first year you get 60, second year you get 60. But second year, out of the 60 that you get, you reinvest a total of 100, right? So you are left with negative 40 after the first year. Then you discount your cash flows. And you get 7.55. Right. Now between S and L, which one would you prefer? It's easier to compare S and L now because both are 4-year projects. From L, you get 6.19. S, you are getting 7.55.
Yes.
Go for the higher NPV, right? So you invest in S. This is the most important thing. You need to identify whether you are reinvesting or not. Depending on whether you are reinvesting or not, your choice will be different. Clear? Any questions? Yes, Dinesh. Yeah, Dinesh, what is your question?
In the question paper, it will tell no whether it is reinvest or not.
Yeah. Good question. Okay, so this is the second way of doing it. Now, we go back to S. if it's a 2-year project, it gives an NPV of 4.13. Right. Then if you are reinvesting again at the end of the second year, you will get once again cash flows like this. No? Cash flows. Investment, these are the cash flows. Investment, this will be the cash flows, right? The NPV of the first investment is 4.13, correct? Then the NPV of the second investment, again the same, no? It's 4.13, no? But you get it at the end of the second year. You have two NPVs which you get at the end, today's NPV and the NPV at the end of the second year, right? So two NPVs at different points of time. Now, if you calculate the present value, it's straightforward 4.13. Here it is 4.13 divided by 1.1 to the power total NPV value is 4.13 plus 3.42, 7.55. You get the same answer, right? So you can use either of these methods. As long as you don't get confused, use that method. Okay. Any questions? All right. So if there's a small twist, if you're reinvesting, but the capital amount required is slightly higher. Okay, remember, initially you need 100, but if you require 105, then what happens? Shall we rework and see? Now, the difference is first year you are investing 100, second year you're getting cash inflows of 60. Second year you're getting cash inflows of 60 and you're investing 105. Okay? You get inflows after that of 60, 3 and 4. So you calculate your discounting factor and the present values, you end up with a net present value of 3.4. Yeah, which is now less than what you originally got. So any questions? So either way, it's the same concept. You see what is the amount you're going to reinvest. If you're going to reinvest the same capital amount, then you put the same capital. Otherwise, you put the new capital amount and see whether the cash flows are also changing. Okay. Yeah. And then you compare the two net present values of the projects. Right? And you need to invest in the higher one. And choosing the optimal capital budget. Right? Invest in all projects if net present value is 0. If capital is unlimited. Pretty obvious. Right? Meaning if projects are independent, you invest in any projects which gives you NPV, a positive NPV. But if capital is limited, invest only in selected projects. If you have only limited capital, you need to pick and choose which projects you can invest in. In this case, either increase marginal cost of capital or use capital rationing. Marginal cost of capital is the capital that you require to raise one additional unit of capital. Right. Remember marginal cost. So marginal cost of capital is the additional cost you have to incur to raise one unit of additional capital. Right. The capital rationing. Okay, which means about it discusses about prioritizing capital. It's required because investments are not made in all projects, which result in positive NPV, and upper limits are imposed on future investments. Then reasons for optimizing capital budgets: to reduce direct and indirect cost of raising capital, right? Because you can't be raising capital all the time, expensive exercise, and you have to minimize your cost of raising capital. You're left with insufficient resources to invest in all projects that give positive NPV. Right? Your resources are limited. Obviously, your capital is also limited. So you have to optimize. Next one is the profitability index. It's the ratio between present value of future cash flows to initial investments. Right? And let's do an example and see. Let's project A. Shall we calculate profitability index? Project A. Profitability index equal to 1 plus NPV divided by IRR. 1 plus discounting factor at 10%. NPV is 18.78. Sorry, divided by investment. $1.19. Okay, so any questions? Now with profitability index, the investment decision is you invest if profitability index is more than 1, right? So invest if the profitability index is more than 1. Now, if projects are independent, what would you do? If the profitability index is less than 1, then you won't invest, right? But if the profitability index is more than 1 and the projects are independent, what will you do?
We select the highest
No.
highest
Yeah.
profit.
That's if they are mutually exclusive. But if they're independent,
Select only which is higher than 1.
yeah, if independent, you invest in any project which has a profitability index more than 1. Right? If mutually exclusive, the highest profitability index. If the profitability index is less than 1, it means the profit is having a negative NPV, right? In which case you will not invest. Now, the points that we discussed so far are based purely on financial factors, right? Also, by the way, profitability index, these are the advantages and disadvantages similar to NPV. And you don't have to do anything additional, just calculate NPV. But the main advantage is no. Sometimes size matters. No, most of the times it doesn't matter, right? So if you are comparing projects with different sizes, then profitability index might be useful, because if one project is giving a 10% return and the other one is giving a 20% return, you might wonder. You might have to look at the size of the investment. Right? Maybe the 15% or the 20% return project is a massive one, right? It's beyond your scale, or it requires additional information. But if you are looking at a smaller project, right? Now let's say you're looking at two projects. One is a 1 billion rupee investment, other one is a 1 million rupee investment. Out of these two investments, which one would you pick? The 1 billion rupee investment gives a NPV of, let's say, 5 million, right? 1 million investment gives an NPV of 500,000, right? Now, if that is the case, the 5 million, if you don't look at the size, 5 million looks attractive. But if you look at the size of the project, then it doesn't make sense investing in the bigger project, no? Right? So that is when profitability index can be used, right? It removes the distortion of size. Now, when the distortion of size is removed, you can invest in the most efficient project, right? So that is the advantage of profitability index. It removes the distortion of size. You can compare projects which have different sizes. Okay. Right. What I was mentioning earlier is that these are all based on financial factors, right? We are looking at all the financials, whether it's payback, NPV, or IRR. It's all financial factors. Now, when you make an investment, would you look only at financial factors, or do you look at other things also? Should you look at other things also? Or should you only look at financial factors?
We are looking at other factors, no? There are some legal factors.
Yes, very good. You need to look at other things also, right? As you rightly said, perhaps legal factors. Because there is no point engaging in a project if it is illegal. Right? It might give a massive IRR or an NPV, but no point if it's illegal and it's not in compliance with rules and regulations. What else? What else would you look at? If you take company like Gillette, yeah, sorry, you were going to say something.
Political and geographical factors.
Okay, yeah, you need to look at the macroeconomic factors. Including political factors, geographical, economic, social, technological factors, right? Good. Anything else? What I was going to say is, if you take a company like Gillette, right? They are in the business of selling razors now. Now they sell the razor at a loss, right? The razor is being sold at a loss, but they recover it from the blade because you need to refill using blades, right? They make money on the blades. So if they look purely at the razor, which is making a loss, can they afford to drop the razor? They can't. Why? Because if they drop the razor because it's making a loss, no one will buy the blade only. Yeah. So they have to sell the razor, which is a loss leadership product, but the losses can be recovered and they can even make profits using the blade. Okay, so if just because you look at financial factors and you drop the razor, it is going to be a disaster. So you also have to look at non-financial factors, financial as well as non-financial factors. Very important. Understood? Any questions so far? No questions? Right. So if that is the case, let's move on to the next area, which is on fixed income securities. Right. So what do you mean by fixed income securities? All right. So we want to fixed income securities. Now, what do you mean by fixed income securities? How many of you have done fixed income?
Debt securities.
Very good. Yeah, debt securities. Usually debt securities or fixed income securities, right? So there are two types of securities. Now, one is equity, other one is debt. Right? And equity and debt can be used to raise capital. Now, if you raise equity capital, you become an owner of the company, right? Usually, right? So debt securities can be issued either by a government or by corporates. So if it's issued by a government for a period more than 1 year, they're called treasury bonds, right? And if it's a debt security issued for a period less than 1 year, it is called a treasury bill. And so you have treasury bonds which are issued for periods more than 1 year. Treasury bills are issued for periods less than 1 year. 1 year is the maximum. Then if a corporate issues a debt security and if it's more than 1 year, it is called a debenture, right? Corporate debt securities issued for less than 1 year is called what? Any idea?
Treasury bills.
Yeah, treasury. No, treasury. The name itself implies that it's issued by the treasury, meaning the government. But if a corporate issues short term, it is called
Commercial paper.
very good commercial paper. Right now, banks are not allowed to issue commercial paper. It's illegal for a bank to issue commercial paper. Fixed income is an investment that provides a return in the form of fixed periodic payments and the eventual return of principal at maturity. Okay, so you get a payment at a specified time period, at a specified interval. Those are called coupons. And when the instrument matures, you get your capital or the principal amount back, right? But actually, what you get is a coupon payment plus at maturity the face value. Right? It may not be your capital because you might invest, for example, 110, and you will get coupons in between every 6 months. Let's say coupons of 5, and when the bond matures in 10 years, you will get the face value of 100, right? So it's a return in the form of a fixed periodic payment and the eventual return of principal at maturity. So remember, you don't get the investment at maturity, but you get the face value at maturity, not the investment, which may not be the investment amount. For example, if 5% rate government bond where $1,000 is invested, right, it pays $50 annually until it matures. So let's do the working. Right. It's 1,000 for the face value bond, right? It's 5% fixed rate government bond, $1,000 invested. So let's say you get annual interest. And it's a 5-year bond, right? A 5-year bond which is 5% coupon. $5 of face value of 1,000, which is $50 every year. Annually, you get $50. Then at maturity, so these are the cash flows that I'm writing down. You get face value when the bond matures. Remember, face value is 1,000, and the coupon is based on the face value, right? And no sooner you see this, what runs through your head? You see a series of cash flows which you receive over a period of 5 years, right? So initially you get a coupon every year of 50, and when the bond matures, you get the face value of 1,000. So what is the first thing that runs through your mind?
This is
Yeah.
like a fixed deposit.
It's like a fixed deposit. Why?
And maybe we are getting fixed return.
There is no default risk.
Yeah, that's also a very good point. Well, actually, before we come to this, let's spend a little more time on that. Now, we said that when a government issues beyond 1 year, it's called treasury bond, and the government issues less than 1 year instrument, it's called treasury bill. Right? When a corporate issues more than 1 year, it's debenture. Corporate issues less than 1 year, commercial paper. Now, what is the difference between treasury bill and commercial paper, and also treasury bond and debenture? What is the main difference? You rightly said it. There is no default risk, right? How come there is no default risk? There is no default risk on which instrument?
Government.
On the government paper, there is no default risk. Why? Because let's say this is the bond that the government has issued. Right? The central bank has issued this bond. Every year it pays coupon of 50. When the bond matures, it pays a face value of 1,000. Right? Now, by any chance, if the government doesn't have money to pay either the coupon or the face value at maturity, what can the government do?
They can print money.
Yeah, the government can print money, right? But let's say if John Keels, a company like John Keels had issued a debenture, 5 year debenture with annual coupons of 50 and a face value of 1,000, when the debenture matures, if John Keels doesn't have the money to settle the coupons, can John Keels print money like the government?
No, they can't.
They can't, right? It's a criminal offense to print money. Okay, so the government is vested with the authority to print money, unlike John Keels. Clear? Meaning, if you invest in government paper, either treasury bill or treasury bond, you are eliminating what risk?
Default risk.
Default risk. There is no default risk. There is no risk of default. So these are default risk-free instruments or credit risk-free instruments because there is no chance of default. So if you invest in a government bond, does it mean you have invested in a risk-free instrument?
No, but still there's interest rate risk.
You're still exposed to interest rate risk, right? Interest rate risk is there, which means this is a 5 year bond. So if you invest in this bond and your return, let's say, is 5%, right? 5 year bond, if you had invested at a rate of 5%, if all of a sudden central bank hikes interest rates like what they did about 3 days ago, and the interest rate shoots up to 15%, then you're going to lose or gain. Because you have invested at 5%. Central bank hikes interest rates to 15% all of a sudden. Will you lose or will you gain?
Lose.
You lose because you're stuck with a return of 5%, whereas the market is now going at 15%, right? So you're going to lose. But if interest rates drop to 3%,
You gain.
you gain, right? So if rates go up, you lose, and if you invest and rates go up, you lose, and if you invest and rates go down, you gain. All right? Which means you are exposed to interest rate risk. Then what are the other kinds of risk? The other kinds of risk in investing in treasury bonds. Yeah.
Liquidity risk.
Okay. Yeah, you might be exposed to liquidity risk, and because sometimes bonds might not be liquid, right? Especially well, in Sri Lanka, the bond market is not very big compared to most of the other countries. So you get maturities which are illiquid, right? So you might be stuck with some bonds until they mature. Although you want to sell, you might not be able to sell. So you are exposed to interest rate risk, liquidity risk. But technically, treasury bonds are supposed to be very liquid. And so that's why you are allowed to include them in your liquid asset calculation also. Then what happens if you are a foreigner? If you are a US citizen and you bring dollars to Sri Lanka, convert them and invest in Sri Lankan rupee bonds, then what happens?
They face a sovereign risk.
Yeah,
Sovereign.
very good. The exposure is sovereign risk, right? Because if the country runs out of rupees, no problem, we can print. Okay, but if we don't have dollars, we can't print dollars. The Sri Lankan government cannot print dollars. Can print rupees, but not dollars, right? So if you are a foreigner and you invest in Sri Lankan bonds, yes, you export to sovereign risk. Now, the other thing is Sri Lanka has issued sovereign bonds as well as Sri Lanka development bonds. Those are denominated in which currency?
US
US
dollars.
dollars.
In US dollars, right? So if the country and if you have invested, if you're a Sri Lanka and you have invested in sovereign bonds or SLDBs, then do you carry credit risk or do you not carry credit risk?
We carry the credit risk.
Yeah, you do carry credit risk. Why? Because the country still can't print dollars, right? You cannot print dollars. So if you run short of, if the government runs short of liquidity, they can print rupees, but not dollars. Okay, but if you had invested in US government bonds denominated in dollars, then if the US runs short of money, they can print dollars. Okay, so the US can print dollars unlike other countries, which gives them a huge advantage. Understood? So that's a very valid point that you brought up. Okay, any questions up to now? Why would you invest in fixed income securities? Oh, sorry, before that. Okay, going back to these cash flows, right? Now, the moment you see cash flows which you receive over a period of 5 years and the cash flow, and let's say your discount rate is 10%. It's called the yield. What would you feel like doing when you see these? When you see several cash flows, and a yield, right? Cash flows which you receive over a period of time along with the yield. Yeah. Very good. Ramadas, you're right. You can calculate the net present value, isn't it? See, these cash flows, along with what we were doing about 10 minutes ago, right? Discounting cash flows. Remember? So you can straight away find net present value. Now, can we quickly do it? What is the net present value if you discount these cash flows at 10%? Yeah, found it. The discount factor. All right, so you get a net present value of 810.46. Did all of you get the same answer? Yeah. Okay, so that's close enough. 810.40. Now, my friends, this is the price of a bond, believe it or not. You have just calculated the price of a bond, right? 10 minutes ago, you had no clue how to calculate the price of a bond. You know now. Very simple, no? Just calculate the net present value of the series of cash flows of a bond. And you end up with the price. This is the price of the bond. Okay. Now, the discount rate, in this case 10%, right? That is, it actually represents the return that you get, right? That's why it's called the yield. Okay. Yield means what is the return that you get by investing in this bond. So what is the difference between the coupon and the yield? Coupon and the yield. See, there are two interest rates. One is the coupon, other one is the yield. What is the difference? There is a coupon of 5 and the yield is given as 10. So what is the difference? Do they mean the same thing or different things?
The maturity rate of the yield is equal to the coupon rate.
Yeah, but actually, coupon is also part of your return, right? So what forms your total return? Now look at this investment value or the price of this bond, 810. Meaning today you're investing 810. And when the bond matures, you're getting 1,000, right? 2,000. Today you're investing 810. And when it matures, you're getting 1,000. That means your investment today has increased by 1,000 minus 810. 189.54. That is one form of return that you're getting. Yeah, the investment amount increasing to 1,000. On top of that, every year from the time of investment, you're getting periodic coupon payment, right? So your total return will be 809, 189 plus 250. Well, it's just ignoring the present values. Okay, so the periodic payments of 50 plus the 189 is forms part of your return. Okay, so remember, coupon is part of your return. The balance comes from the increase in the face value, right, or the increase in the investment amount. Clear? So why would you invest in fixed income? To diversify. Now, if you have invested in entirely 100%, you have invested in stocks, right? If the stock market has a downturn and if you don't get any dividends, your revenue streams are going to dry up. Now, you can reduce the impact, the negative impact of that to a certain extent if you invest in government or bonds or debentures. Why? Because at least you will get a coupon payment from time to time, which you can reinvest, right, in wherever you want. So that's one thing you can do. Okay. The other thing is it provides a form of income. Okay. It also helps diversification. It helps you to diversify because it's a different class of instrument. You can invest in corporate bonds or government bonds, then across various tenors, maturity periods. You can select various coupon payments, right? You can reduce the entire risk of the portfolio, right? Credit risk, you can eliminate completely if you invest in government bonds. Then there can be tax advantages, right? So if you invest in government bonds, now there is no advantage, but there was a time when bond revenues were exempted from withholding tax. Now it is included, but sometime back it wasn't. By the way, when you invest in corporate bonds, you might look at credit ratings. Right? Can you tell me some of the agencies which give credit ratings? There are credit rating agencies. Can you name some of them?
Fitch.
Very good. What else?
Moody's,
Moody's,
Fitch,
yeah, Fitch.
Standard Poor,
Very good. There is one more in Sri Lanka. Yeah, ICRA. Isn't it? So credit ratings, there are two types. One is called investment grade. Other one is called non-investment grade or junk. Right? Investment grade. What is the highest possible investment grade? Highest possible investment grade? Hello? Come on, guys. These things you should know. Right? Very disappointing if you don't know this simple thing.
AAA plus.
It's AAA. Okay. There's no AAA plus. Highest is AAA. But good, at least you tried. What else? After that, what comes after AAA?
Double A.
Yeah, AA plus. Then you get AA minus, A plus, A minus, triple
Above
B.
B,
Huh?
above double B,
Actually, it's above,
double B.
no, above triple B minus is investment grade. Right? Non-investment grade, what is the highest? Double B plus. Right? Then you get double B minus, B plus, B minus, triple C plus, triple C minus. Yeah.
Excuse me, sir. I don't see what you're typing.
Ah, sorry. Thank you. Okay.
Two equals.
Can
Okay.
see. Yeah. Right. Then below this are the default ratings. Now, where is Sri Lanka? Sri Lanka is somewhere there, right? As a country, the country rating is around triple C. So, what is the benefit of going up this scale? The countries like US, Japan are AAA.
The investments are coming.
Investments?
The people tend to invest in those countries, right?
Yeah. Because see, the perception of risk, that the perception that you might default will increase as you go down the scale. But as you go up, as you progress upwards, the perception of default will keep dropping. Right? It will be less likely that you will default. Okay. So, for example, if you take a AAA company or a country, the chance of a AAA country or company defaulting within a period of 1 year is less than 1%. Okay. So it's that good, meaning it's one of the safest investments you can make. Now, when the risk of default reduces, the default risk premium also reduces. Right? Default risk premium. Because if you look at US, 10-year bonds. They're going at about 1.5%. US 10-year bonds are going at about 1.5%. How about Sri Lanka's? These are both dollar bonds. We're talking about dollar bonds. Sri Lanka's 10-year bond. Going at around 18%, close to 20%. Percent in the US, meaning there is a difference of about 18%. This is called the spread between US and Sri Lankan bonds. The spread consists of default risk, premium, and liquidity risk. Default risk premium plus liquidity risk premium consists of this 18%. This 18% consists of these two mainly. Okay. And as you go down the scale, the default risk premium will keep increasing. Also with it, the liquidity risk will also increase because less and less people will be willing to buy. If there are less people willing to buy, the liquidity will definitely drop. Right? So that is the benefit of having a high credit rating. Any questions up to now? No questions? And the risks. Treasuries do not have default risk, unlike corporate debt, since governments have been vested with the power to print money, right? That we discussed earlier. But they are exposed to interest rate risk and liquidity risk. If a government issues securities that are not denominated in its local currency, there is a possibility of default, which is called sovereign risk. Settlement risk, right? Remember, bonds have no settlement risk. Treasury bonds in Sri Lanka have no settlement risk because they settle based on a system called DVP, RVP, right? Delivery versus payment and receipt versus payment. That means settlement happens simultaneously. You pay and you receive bonds at the same time. Recently, in fact, last Monday, even the stock market moved into DVP, right? That means payment and settlement happens at the same time. When that happens, there is absolutely no risk of default. Why? There is no settlement risk. Right? Settlement risk is also called Herstat risk, which is associated with a bank. Okay, now take something like foreign exchange transactions. If a local bank, or let's say two local banks are trading amongst themselves, right? Let us assume that, I'll put that on an Excel sheet once again. Let us assume that Bank A, right? There are two banks, local banks and Bank B, whatever name you want, right? Let's say Bank A buys $1 million from B at rupees per dollar, right? This is the underlying scenario. Bank A has bought $1 million from B at a price of 200 rupees. Let's say value date or settlement date is 3rd August. Meaning tomorrow, right? So the settlement should happen tomorrow. A has bought $1 million at a price of 200 from B. Now on 23rd August, what happens? What will A pay to B? Yeah. How much will bank A pay to bank B? In which currency? Yeah. So, what will A pay B? A has bought $1 million from B. So how much will A pay to B?
$1 million.
No. A is buying dollars. So A will pay B how much? If you're buying a car, right? You get the car and you pay rupees, no? Isn't it? It's like if A has bought a car from B, yeah. How much will A pay to B?
200 million rupees.
Yes. They will lose, they will pay 200 million rupees. An outflow, which happens during Sri Lankan time. Okay, which is the RTGS open time. It's from about 7 o'clock in the morning to 3:30 in the evening. Right. So let's say this payment goes at 9 a.m. Sri Lanka time. Now, how much has B got to settle A? If A has bought a car from B, A will pay 200 million to B. Will B pay A?
$1 million.
Yeah. There will be outflow of $1 million from A. Sorry, from B. Right. So A is paying $200 billion Sri Lanka time 9 o'clock, and B has to pay $1 million to A at what time? What time will it happen? It will happen during US time. US time 9 a.m., which is about 9 p.m. Sri Lanka. Isn't it? Look at this. A has paid 200 million B, 9 o'clock in the morning, Sri Lanka time. Right? But B is giving $1 million to A 12 hours after that. Correct? There's a 12-hour gap. Now, between these 12 hours, anything can happen. Right? 12 hours is a long time in financial markets. There is no guarantee that B will pay A during that time. But by any chance, if B goes bankrupt during the course of the day, then they will be unable to settle it. Then this transaction gets settled through nostro accounts, right? So if B's nostro account is, let's say, with Deutsche Bank, New York, A's nostro account, let's say, is with Standard Chartered, right? If during the course of day, after 9 o'clock Sri Lanka time, if all of a sudden Deutsche Bank goes bankrupt, or if Standard Chartered goes bankrupt, then either Deutsche Bank might not be able to settle to Standard Chartered, or Standard Chartered will not be there to take the money from Deutsche Bank, or both. Okay, so there's 12-hour gap during which anything can happen. Okay, so there is no guarantee that A will receive the dollars from B. Now, in the morning, by any chance, if A did not give the rupees to B, then B has about 12 hours to cancel the payment to A, right? So the risk of B in this case is less because they are getting the rupees before they give the dollars. But after A gives the rupees to B, then A's liability ends, right? B will receive the rupees, right? But there is no guarantee that A will receive dollars from B. Okay, so there can be settlement risk. Now this thing has happened. This has happened. The bank called Herstat went bankrupt before they settled their transactions. It's called Herstat risk or settlement risk. Understood? Yeah?
Yes.
Okay. So this can happen when it comes to foreign exchange because of the time difference, right? But if they were trading bonds, A and B were trading bonds, if A bought a bond, treasury bond of say 1 billion from B, right? A should receive the bond and they should pay. Earlier, remember 810.46. Okay, let's assume that the bond we did earlier is the transaction 840, 810.46. Right? So A should pay 810 million to B, and B should deliver bond 1,000 million face value to A, and they will receive 810.46 million rupees from A. Right? Now DVP RVP means both of these transactions should happen at the same time, right? Meaning A should make available 846 rupees, and B will have to make available the 1 billion rupee bond. Right? If both of these are in place, then the transaction will get settled. Otherwise, they will not get settled. And if either one party moves out, bails out, the transaction will remain unsettled. All right. So that means this DVP RVP system eliminates settlement risk. They will match the two payments and do the transaction, right? So there are special Swift messages, 5 series if I'm not mistaken, to settle bond transactions. Is that clear? Understood?
I didn't
Yeah.
understand that.
Which one? This one, the bond transaction.
Yes, this settlement.
Okay, so this is A and B once again. A is buying a bond from B now. Forget about bonds. Let's say A is buying a car from B. Right? A is buying a car from B. Now this bond is the car. In the car, they had to pay 810.46 to B. Okay.
Okay.
Right? Now, at the time you are paying 846 if the car is not ready. Now, car I'm just using as a analogy, right? You can substitute it with the bond. So if at the time you are giving the 810.46, if the car is not ready, your 810.46 payment will not go, right? Or at the time B is giving the car to A, if the payment of 810.46 is not ready, still the payment will not go. Okay, for the payment to go through, both the car and the money should be there. Or in other words, the bond and the money should both be there. Right? Unless both are there at the same time, this payment will not go through. Understood? So it's called DVP RVP, settlement process. Clear?
So, is it the term or is it in practice?
Meaning?
So, why it is that if it is a bond is not there, why the transaction is not happening? So it is transferring through RTGS. It can be happen, no?
Yeah, it is RTGS, but for the settlement to go through, both the bond and the money should be there at the same time. Right? If the bond gets delayed, now if let's say you're buying it from someone else and giving it to a third party, if B is buying the bond from C and giving it to A, right? If C doesn't settle B, then B will not have the bond, then it will not go through. Or if B is unable to find the bond, then the settlement will not go through. Did I answer your question?
So is it because of time difference?
No, this is local transaction, all Sri Lankan. Rupee bond and rupee payment. So there is no time difference.
That means it's within that 12-hour period.
Within?
That 12-hour period, is it?
No, these are Sri Lankan bonds. This is earlier one was a foreign exchange transaction. This is a forex. This is rupee transaction. These are rupee
So that
transaction.
is, I think, a systematic thing, no? That
Systematic means?
DVPRP thing.
Yeah.
DVPRP process is a systematic process.
Yeah, all processes are systematic. No? To the system.
Right.
What do you mean by systematic?
It happens simultaneously. One party can default. How it happens? That's the thing. It means through the system it's blocked or what?
Yeah, the system doesn't allow unless you have both the bond and the cash at the same time.
Right.
Oh,
Right.
yes, that's the thing that
Okay.
I have a doubt.
Clear.
Yeah. Sometimes if you don't have the money, right? Let's say if this settlement process was not there and you deliver free or receive free, then it's called deliver free or receive free. That means without going through this process, you can do it separately also. But usually bond transactions happen DVP, RVP, right? If it has to happen deliver free or receive free, then there is a special approval process that has to be obtained by the treasury guys, right? 100% of the transaction should settle DVP RVP. Now, for example, let's say that A did not have the money to buy this bond, right? If A didn't have the money and this settlement system wasn't there, right? And B would have delivered the bond before receiving the money, and A would have told, "Ma'am, passe denna salli." Okay, so if that had happened, then end of the day also B might not receive his money. Likewise, if B had promised to sell the bond to A and A had transmitted the money to B before receiving the bond, B might take the money and vanish, disappear without giving the bond. Right? To eliminate that risk, this settlement system is in existence. DVP, RVP, no risk. Right? So it's like the right hand gives the money and the left hand takes the bond at the same time. Both happens at the same time. Clear? Any more questions? Hello?
Yes, in the foreign currency thing that you explained earlier,
Yeah.
and that is because it is a value settlement. No, otherwise,
What does
it
that
is,
mean?
that means that
This is value date. Value date means the settlement date. It's also settlement. $23. Only difference is this is in two countries, no? Sri Lanka and US, because this dollar settlements happen not locally, no? Two Nostro accounts, right? So B will have to transfer the dollar to A's Nostro account, which is open only during New York time. Whereas bond settlements happen through the central bank, open during Sri Lanka time.
yes, okay.
Clear, or you have any more questions?
Clear, sir. Thank you.
Yeah. Any further questions?
So because of this time gap,
Yeah.
so
Yeah.
one country can do purposely they can do forgery transactions. It means
Yeah, but then that will be the end of their business. If they want to default and play out, yes, can do. But that is why the reputation of a bank matters. No? You don't do deal with any bank, no? Only a bank with a certain stature. Yeah. Okay, no more questions? All right. Good. That was a very productive discussion. I hope I addressed your doubts. If there are any more further questions, which you might be using practically, yeah. So you can always ask. The difference between coupon and interest rate. That's what I explained earlier also. Well, yield is your return. So coupon is part of the return. Coupon forms part of your return. Okay, the increase in face value and the coupon forms your total return. Okay, so the yield is your total return. In other words, it's your IRR. Shall we do another exercise? The previous one that we did. This one. What do you think will be the IRR of this? IRR of these payments. What happens if you discount your cash flows at 10%?
So we can't see the Excel.
Oh, sorry. This one, right? What do you think will happen if you discount all of these cash flows? Or what do you think will happen if you find the IRR of these cash flows? What do you think will be the IRR? Now, this is like you're buying this bond at what price?
810.
810. Right? If you buy a bond, that means a cash inflow or an outflow? Outflow. Outflow, right? So today your investment will be 810.46. If you calculate IRR of these cash flows, what do you think the IRR will be? What would be the IRR? Any idea, guys? It will be 10%, right? So let's discount the cash flows at 10%. And let's calculate net present value. You get 0. Okay. So when you discount at 10%, you get a net present value of 0. Meaning 10% is what? It's the discount rate at which net present value is 0. In other words, 10% is the, yeah. What is the discount rate at which net present value becomes 0?
IRR.
It's the IRR. Yeah. So your return or the yield is your IRR. Clear? Understood?
Yes, sir.
Okay, so that's all there is on bond calculations. If you understood that, that's it. Right, so the risk of settlement can be eliminated using DVP, RVP. Yeah? The market interest rates. Now, these are based on market forces. Interest rate is what? How would you define interest rate? What is an interest rate? Yeah, how do you define an interest rate?
Proportion of loan.
Okay, well, to me, interest rate is the price of money. Right? It's the price you pay for money. Yeah, and price is based on what? What drives price?
Inflation.
Yeah, but price, any price, the price of a loaf of bread.
Value we get. Value we get.
Yeah, what we learned in grade 2, price is determined by
Earnings.
demand and supply. Basics. Agreed? Price depends on demand and supply. No? So likewise, the interest rate is also dependent on market forces or demand and supply factors. Things like the risk-free interest rate. What is the treasury bond rate going at? Like if you want to invest, let's say, in a 1-year FD, you are deciding between 1-year FD rate and 1-year treasury bill rate, right? So if the treasury bill rate is 6% and the bank is offering an FD rate of 5%, where will you invest? Yeah, you obviously invest in treasury bill rates because without taking credit risk, you're getting a return of 6. But the bank is offering only 5. You will not go to the bank, you will straight away invest in treasury bills, right? So the risk-free rate matters. Then inflation. If inflation is 10%, you will try to get a return which is on top of 10%. Otherwise, you are getting negative returns. Then default risk premium. Remember what we discussed earlier? The US Treasury bond 10 years 2%, Sri Lankan bond 20%. Right? The excess is because of default as well as liquidity. And maturity risk premium, right? Now, if you are getting for 10 years, investing for 10 years, if you are getting a rate of 10%, and if you invest for 9 years, you get 15%, which one will you prefer? To invest for 9 years and get 15% or 10 years and get 10%.
Nine years, 15%.
Exactly. Right? Because longer the tenor, higher the return you require, maturity risk premium. And why do governments issue debt? One is to borrow, right? If a government has a borrowing requirement, they will issue debt securities to borrow. Right? So government borrowing requirements are matched using treasury bills and bonds. Then to control money supply. That means when the government issues treasury bonds or treasury bills, the investor will be giving rupees to the government or to the central bank, right? So that rupee amount will go out of the market, liquidity will drop. Then to control interest rates, when by manipulating or by changing interest rate liquidity in the market, interest rates also can be controlled. Right? For these purposes, governments will issue bonds and bills. Okay, time is up for today. No? Shall we wind up?